Good evening. It's June 2nd and it's Thursday. Welcome to episode 45, Market Recovery. Good afternoon to you, Wawi.
Good afternoon, Mark. How are you?
Good. How's it going?
Busy,
I
hot
think it's
and busy.
Oh, cool. Well, I hope everyone's doing just fine and our apologies for missing out last week, but this week we're back. This is your host, Mark Yu.
Wawi Santos.
And welcome to the Mark Yu and Huawei Show. Disclosure: this show is made for sharing information purposes only, and not to be considered investment advice. I and Huawei record once a week. We're both physical therapists here in the USA, with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. As I was zooming in, Kuya Huawei, looks like Dow closes 400 points higher amid rate hike discussions. So somehow we're back in the uptrend.
Yeah, we had a bear market rally,
Yes.
a big one
Well,
too today.
well, we'll see how it goes. Hopefully, it's just not a bear market rally because it just means bear market is still looming. It means that we're soon to go down again. But before we go on to our weekly sentiments, for those who have missed it, previously, episode 44, welcome to the bear market. We discuss increasing trends in layoffs, S&P 500 valuation, and the drastic stock price drops in large consumer discretionary companies such as Walmart, Target, TJX, Ross Stores, Home Depot, and Lowe's. So for those who have missed it, feel free to listen to that episode. For this episode, now we're going to jump on to our weekly sentiments review. So we missed last week's and we're going to tackle this week. So last week, the bullish sentiment, according to the American Association of Individual Investors, bullish sentiments as of yesterday was up 32% from last week's 19.8%. So a lot of people are becoming more bullish now, even way more than last month. So last month we were seeing like 19, 18, like really low bullish sentiments. So for those who are not aware, bullish means people think that the stock market will generally go up, bearish stock market will go down. So a lot of people getting bullish, Huawei.
That's good.
Mhm.
Yeah,
And I feel like it kind of reflects the market performance as we're gonna tackle in a little bit in the past week, let alone in the past month. So some green shoots forming in the stock market, even though a lot of like prominent individuals in Wall Street thinks that there's a storm or hurricane up ahead. So the fear and greed index, we're still at hovering at fear sentiment. We are at 28, whereas 1 week ago we were at 13. So quite a jump, but still at fear range. The market momentum, which is between the S&P 500 and its 125-day average. So right now we're still below the 125-day average, or for the past at least 30 divided by 120 divided by 30 for the past 4 months. The S&P 500s at this point of time is still below its average for the past 4 months, which indicates we are still at extreme fear. Put call options, the tail that wags the dog. We are still at fear. A lot of people still buying put options, betting that the market would go down. Market volatility, the volatility index, and its 50-day average, we're at just its average, around 25, which means we're at neutral at this point in time. Put call ratio, where it's still high compared to past 6 months. We are at the levels of February at this point in time, but you can see here the decline for the month of June compared to May. For the past week, like what me and Wawi has just mentioned, we are seeing green on all three indices: the Nasdaq, S&P 500, and Dow Jones. Interestingly, Nasdaq which has been the worst performer among the three since the start of the year, It's up almost 8% for the past 5 days alone, followed by the S&P 500 up 5%, Dow Jones up 3.5%. For the past month, S&P 500 is up 1%, Dow Jones 0.8%, Nasdaq almost flat, but still positive 0.3%. So this is the start. Since the start of the year, if you're going to take a look at it, a little review, Nasdaq is still down 21%, followed by S&P 500 down 12.4%, and then Dow Jones down 8.5%. So interestingly, while we were at like very low points last month, like down 25%, right, on Nasdaq,
Yes.
which
Yes.
carries the tech sector, the FANG stocks, Facebook, Alphabet, Amazon, Netflix, and Google. So slowly we have recovered somehow, at least until today. The
Mhm.
volatility index for the S&P 500, it's down 12% for the past 5 days, which means that we haven't seen any huge quiet sell-off so far in the past 5 days since the start of June. The Nasdaq volatility, the VXN, it's down likewise 11%. It's not much volatility happening, some recovery happening. And if we're going to take a look at per industry, all sectors, industries are in the green for the past week, led by consumer cyclical, followed by technology, consumer services, communication services, and the rest. For the past 6 months, best sector, obviously, energy sector, almost 50% for its group. Utilities, which is a good inflation hedge, is the second best performer, 12.7%. Basic materials, it's up 10.8%, followed by consumer defensive at 2.6%. All the rest are in the red, led by consumer cyclical and technology. So while we quickly here, looks like past week alone, the worst performers since the start of the year actually are leading the recovery, the consumer cyclical and technology. So could this be a
Mm.
bounce for good, or just a deadly bounce?
Well, I think it just hit bottom. I
Mhm.
think I think the technology sector has hit bottom and now it's bouncing back up.
I
And
hope.
it's
Mhm.
a lot of the technology stocks have gone down. Some have gone down like 80% or more.
Right.
So so it's so I think people are pricing it in and seeing value in these growth stocks, and now they're buying them.
Right. Hopefully you're right on that. We've so far this year we have been suffering sell-off after sell-off, day after day, week after week, in contrast to what we have experienced late last year, or since I think since even June back then when we started our podcast, we were achieving all-time highs after all-time highs on a daily basis. So
Mhm.
hopefully
I
there's
think
we see a change. Mhm.
I think the positive momentum may have something to do as well with the clear signal coming from the Federal Reserve.
Right.
And as we all know, the meeting is coming up June 14 to 15,
Right.
and they would be looking at data at that point, and they would probably, people are predicting that they will increase the rates 75 to 100 basis
Right.
points at that
Yes.
time.
For those who have missed it, me and Huawei tackled this specific issue a couple weeks back. Whereas Wall Street estimates were providing that actually Powell might just increase the rates by around that area, 75 to 100 basis points. But yeah, he did clearly say that it's not going to be less than even 50 basis points. I think if anything, it'll be at least 50 basis points that he'll rate increase in the coming weeks. And in support of the recent uptrend in all the stock market indices, we have seen global equity funds first see its first weekly inflows in past 7 weeks. So the uptrend has been supported by more flows coming in back to the stock market. So according to Refinitiv Lipper, which is owned by Reuters, global equity funds saw money inflows in the week to May 25. So if we're going to look at investors bought a net $6.16 billion worth of global equity funds, the first weekly net buying since April 6th. So we have been in drought. People are pulling their money from the stock market until the last week of May. So there was some turnaround in the last part of May. The big inflows, according to Reuters, into global stock funds were also due to the creation of new shares of ETFs. So even not only in US, but since it's global, obviously, so US and Asian equity funds had inflows of 4.61 billion and 1.22 billion respectively. So more money while he's going into those sectors, US and Asia, whereas European funds just attracted 0.13 or 130 million. So not a whole lot of people buying into Europe, even though that they're discounted more. I think I've seen a report where France is actually in a recession at this point in time, currently. Chinese equity obtained 580 million in inflows. Its first weekly net buying in 7 weeks. So even China, because of their reopening, has received a little more than $500 million of flows, which is a good sign. At least, some people were gaining some confidence in the stock market, right, Wawi?
Yeah, I think China is still in quantitative easing, so that
Mhm.
helps them. That helps them recover.
Right, some positivity at least.
Mhm.
All right, so we're gonna go back into our sentiments review. So now we're gonna take a look at some interesting article snippets. So this came from Bloomberg. It says J.P. Morgan's Kolanovich sees sunny stocks as Jamie Dimon braces for storm. So this is kind of like in contrasting stance, which is coming from the same Wall Street bank. So
Mhm.
Jamie Dimon is a chairman and CEO with a net worth of more than $1 billion of JP Morgan, which is the largest bank in the USA with over $3 trillion in assets. The chairman CEO says that he sees hurricane. Actually, it's here, the second article. Jamie Dimon says JP Morgan is bracing itself for economic hurricane. He says that Fed actions war in Europe create unprecedented challenge. Here we go again with the word, Wowie, unprecedented. Still too soon to say how intense the storm will be. Meanwhile,
Mhm.
his advisor or one of his top lieutenants in the same bank says buy the dip calls. Well, bullish strategist Kolanovich expects stocks to rebound by year end. So which is which? Wowie.
Well, I am expecting some of these technology companies to bounce back up by year end. Um, I think a lot of the fear sentiment is coming from the energy sector,
Mhm.
um, because of the effect of the Russian-Ukraine war to Europe, where Europe has stopped buying oil and gas from Russia. But I think it will be, it will benefit Asia,
Mm.
now that Asia can buy cheap oil. Question is, who's gonna refine it for them? Probably China. So China will be the main beneficiary here.
Right.
So on the lookout for Chinese stocks, see how they move with this recent energy shift,
Right.
oil shifting towards Asia,
Right. Yes.
away from Europe.
Yes, and it's definitely supported by a JP Morgan report yesterday. Whereas, like you said, Russia has not only been able to fully offset the zero point 0.7 million barrel of crude export loss to its traditional customers in US and Europe, but it has managed to sell an additional 1.4 million barrels a day to Asia buyers. So it just means that you're right. If Asia continues to bounce, especially China, that now that they're reopening, and then hopefully everybody goes on with their progress and recovery, then
Mhm.
oil would definitely be needed, and energy expenditure would
And
be
China is coming out of their COVID lockdown as well. So
true.
manufacturing is ramping up again.
Yes,
Uh,
definitely.
I
Um,
think
yeah,
China is. I think they changed some policies there, and looks like um, they're gonna use a lot of coal as well. So they are preparing for a ramp up in manufacturing. Now here in the U.S., we saw an increases in SMI as of last report. So we're also ramping up our manufacturing here in the States.
hmm. Yeah, that brings it to mind what this research has published yesterday by Yard Denny. So he kind of like highlighted here the Purchasing Managers Index, which kind of tracks the possibility of any expansion or slowdown in certain economies. So Yardani came out with this report yesterday. Global index, as you can see here, from 2021 to 2022 has been declining. Anything above 50 is expansionary. Anything below 50 is contraction. So right now we're slowly losing that upbeat um, globally. But if we're going to look at the advanced economies, which includes obviously the first world countries, US and Europe, you could see a slowly decline as well. A little bit plateauing here if you're going to magnify it for the recent 6 to 9 months. But some slowdown have been observed. But if you're going to look at emerging economies, this isn't really a good sign. We are down, contracting since the start of the year on the emerging markets. So if lower oil is soon to be experienced in the Asia economies, and now that China, like what you said, Huawei has reopened, so hopefully this would help them recover um, in the nearest future as they can take advantage of lower oil prices. But yeah, I remember Jamie Dimon saying a month ago, I think, that he would tell us if there be a storm or if he sees anything coming abound in the U.S. economy. But now he's clearly indicated that there's a hurricane um, coming abound.
Mhm.
So definitely a warning, definitely something to worry about. Again, about the stock market performance.
Mhm.
So U.S. job openings, they reported yesterday. So it fell, it rolled over uh, for the month of April. It fell to 11.4 million. But if we're gonna still look at the perspective of history here, we're still at the highest, or at least the employer demand for job applicants. It's still
Mhm.
at the highest point in time over the last, if you're gonna compare it to the last decade or so. So
Well,
nothing.
from
Mhm.
from the report I'm getting, uh, uh, a large amount of the layoffs are coming from the technology sector.
Right. I think we tackled that in a previous podcast, the layoffs. We've seen like more of the startups slowly uh, tankering down, or at least slowing down in their hiring. I think Coinbase also just announced earlier that they're going to slow down in hiring. So some of these tech funds, tech companies, are slowly being concerned on their bottom lines for sure. Because if they keep
Mhm.
hiring and they have to pay high salaries to these employees, then it'll just further crimp up their profitability. And right now, Wall
Mhm.
Street appreciates companies who can deliver profits instead of just growth. So here's another screenshot that we're going to look at. So this one now particularly concerns the real estate situation. So Over the last couple months, or at least since last year, we've been seeing a red hot real estate market. We've seen the prices gone up incredibly, and now we are slowly experiencing a slowdown. So, according to the CNBC article, mortgage demand falls to the lowest level since the end of 2018, even as interest rates ease a bit. So, applications for a mortgage to purchase a home fell 1%. Volume was 14% lower than last year. Prices, although, continue to rise because there is still so little supply on the market. So some slowdown while we in the real estate market.
Yeah, well, you have to think what happened, right? So we didn't build as many houses because of um, supply chain issues uh, starting last year, and but now lumber prices have gone down as far as the report that you posted on our
Mhm.
group.
Yes, down
So
50% from
so I
all-time
would
high.
I would be looking at companies that are building homes right now and see how they're um, increasing their new new home builds, particularly KB Homes, Meritage
Mhm.
Homes. Um, I would be watching them and see how they're moving along. If they are able to catch up with new home builds, then maybe that will start leveling out prices of homes and level the supply and demand problem regarding uh, homes. Uh, Maybe who knows? It takes about what three months to build a house.
Mhm.
So
Well,
maybe
mhm.
yeah, 3 to 6 months, maybe near next end of this quarter, and then on the end of this year should see some leveling off on the supply and demand on the housing sector. And that's just me being optimistic.
Right. And if for those who are interested in knowing the ETF that kind of invests in all these home builders, there's an ETF called Spider S&P Home Builders ETF. So it's ticker XBH. This is not an investment recommendation, but just to see what are their top holdings. There includes Mohawk, Owens Corning, Masco, Toll Brothers, Whirlpool, Poltec Group, Home Depot, DR Horton, and VR. So these are the big companies that you might want to take a look at for being exposed to the property market. But because of the sentiments going down, I don't think, let's see how its ETF had performed so far, at least since the start of the year. So XBH market cap of 1.12 billion. Real estate, yep. It's down alongside with everybody else. It's down 24.8%. But yeah, there's no saying, now that we're seeing some slowdown, like what we said, it's better to read the reports in the coming months of what their
Mhm.
plan is for the supply and completion, if there are any delays or any softening. But investors and listeners, you are in a treat because we've included in this podcast it's really recent. The Redfin just came out with their monthly report that pertains to the real estate insights that they freely provide on a monthly basis. They just published it yesterday, so stay tuned. So meanwhile, next screenshot here: 25% of Americans are delaying retirement due to inflation. So not a good sign. In terms of like before, like early on the start of the year, right, Wawi, we were thinking that this is the time of the great resignation. People are just
Mhm.
leaving and stuff, their jobs and stuff, seeking early retirement, looking for better opportunities somewhere else, finding their
Mhm.
passion. But right now, because of the inflation, the crazy inflation, at least a
Mhm.
quarter of Americans are now delaying their retirement due to this event.
Mhm. Yeah,
And
so you
mhm,
really can't time it. There was well, it for some, I think the Russian-Ukrainian war is predictable, but it came as a surprise for many.
Mm-hmm.
So that played a big role, and then inflation started increasing a whole lot after that war.
Right.
So, um, but looking at the bright side, okay, if you look at the bright side now, if you didn't pull out or realize your gains early this year or late last year, then this is a time to look for bargains.
Mm-hmm.
And there's gonna be a lot of bargains in a volatile market. So
Right.
just keep an eye, make a watch list and see how things are going.
Right. And definitely look into those sectors that have been badly beaten. It's no sure guarantee that they're going to bounce back, but you're actually buying a cheaper price compared to where it was since the start of the year. So that might help your returns over the long term. Next screenshot we have from Reuters. US retailers ballooning inventories set stage for deep discounts. So we've tackled this last week when we look at specific reports from the likes of Walmart and Target and TJX, Ross Stores, Home Depot, and even Lowe's. So you could tell these companies have over ordered, if there's such a term. And now Walmart is actually the one that's increased their inventories by a good amount, by tens of billions of dollars now stuck in their inventory. And they might need to obviously get rid of them eventually so that they won't eat space on their storages. But yeah, so consumer sentiment, we've been harping on this since late last year. It's still at the lowest point for the past decade. This doesn't help the overall consumer sentiment, the buying, and this possible slowdown that's happening. If I can remember it, if I remember it correctly, I saw a report where car secondhand or used car prices have slowed down at least for the month of May.
Yeah,
Yeah.
and that coincides with some reports that semiconductor chips are coming out of the factories again, and
Mhm.
so there's probably we're gonna see some cars in the dealerships now.
Right. Yes, at least inventory increasing for the home first time home buyers.
Mhm.
For the dollar, just a random inclusion here, we are seeing a very strong rise in the US dollar versus all other currencies since the start of the year, not until May 14th, or at least mid-May. And then now we are slowly seeing some downtrend from that point of time. I'm not saying that it's kind of like directly proportional to the stock market, but that's a moment that we are, actually some inflection point that the stock market has recovered slowly for the past couple of weeks at least. And this morning, Microsoft actually came out with earnings warning that they're gonna see slowdown in profits and sales because of the stronger dollar. So it definitely affects, especially the global operating Wall Street banks, not Wall Street banks, but Wall Street companies. So possibly a good sign here for some of the struggling major US major companies. Now we're going back to real estate. So the 30-year fixed mortgage rates. Actually thought back in a couple weeks ago that we probably already had seen the highest 30-year fixed rate for the past year, and then downtrend, but you could tell there's a sudden spike again up here. So from 5 point, let's say a week ago, 5.27, we are 5.27%. This is a 30-year fixed mortgage rate. We're now at 5.45% for the 30-year fix. So it's still increasing at this point in time, if I may say it. So here's the Redfin report that just came out yesterday. They came out, well, it actually came out today, published on June 2nd by Tim Ellis. They say home buyers regain some control as supply grows and demand pulls back. So now we're seeing demand trimming. It says here more than 1 in 5 home sellers drop their price, while several measures of home buyer demand posted largest declines since 2020, since COVID lockdown. So 20% of the sellers have now reduced their price. Nonetheless, looks like we were still averaging at 16% higher median sale price. So this is 50%, at least half of the homes being sold today are being sold 16% higher since last year, around $400,999 per home. Still quite expensive.
Yeah, it is. Consumers are balking on used car prices and home prices. I think they're not gonna buy it because it's too expensive.
Mhm. Still
So
high, yeah.
yeah, so we'll see this demand trend. Let's see if it keeps going down. If it keeps going down, then prices should go down as well.
Mhm. And then we're looking at home buyer mortgage payments. So if we're going to compare the mortgage payments that we have to pay this year, this month, today, compared to a year ago, last year, we're paying 40% more, or on average, at least 2,000 or almost $2,400 a month for the same house. So that's
Ouch.
quite a good jump right there from $1,700 since the start of the year. We added almost $500. That's a, a good hit on our wallets.
Mm-hmm.
Pending sales, so 8% down year over year. So I'm not sure what to do with that, but here we go. This is the more important part. 5% of listings had price drop. So more and more sellers have registered drop in their home price selling point or selling price. So this is the highest that we have seen even since the start of the pandemic. So people are realizing that not everybody is willing to pay for a crazy high price of their homes or their houses. People are slowly getting the sense of that there's no forever in market euphoria, especially in property prices.
Mm-hmm.
So, according to Redfin, we are seeing more price drops than any time since 2019. So, in 2019, mind you, it's a spike
Mm-hmm.
and not been seen for the past 7 years actually, except for the last part of 2019 as well, or last part of 2018. Correct. Stand corrected there. So more and more price drops are hovering for property prices, and
Yes,
the most
and more
important chart. Mhm.
and more sense coming back into the market.
Yes, and the most important chart for me is the Redfin Home Buyer Demand Index. It's now down 9%. So we are seeing actual slowdown in demand for buying houses at this point in time. So we haven't actually seen a negative figure until now. So some quite specific things affecting the overall property market. So I hope we land in a smooth transition and not just crash totally, because that will ultimately affect the overall economy.
Well, when
So
it comes to the housing market,
mhm,
we should watch, that demand and that pricing, along with new home builds. Monitor that, and that will tell you where it's gonna head.
right. And now we're seeing actually, demand actually slowing down.
Yeah,
So
demand slowdown. Home building is ramping up, but how long will it do it?
and lumber prices definitely reflecting this, as it's
Mhm.
been, it has already crashed. It has already lost 50% of its value in the past since its all-time high back in January. So now we're just going to take a look at specific company here. Wow, Costco, it's up 6.7%. They just reported their earnings last week. So Costco trading right now $487 a share. It's a, well, let's give our computer a little bit of time, I guess, there we go, to load itself. So Costco, it's a $208 billion company. Forward price to earnings, 35 times, a little pricey. And so they reported their earnings on last Thursday. They actually beat their earnings estimates and they beat their sales estimates or revenue estimates. Unlike Walmart and Target, which suffered crazy stock price drops, Costco remains resilient. So according to the company, their sales grew 16% since last year to 51.6 billion. That's for their quarter. And their earnings, let's see. Their earnings for the quarter was $1.35 billion. Compared to $1.22 billion last year. So companies still raking in cash. E-commerce business, they say, comparable sales, it increased by 7.9%. So Costco is definitely a stalwart. Let's see, profits. Yep, we've gone through that. Let's look at its cash. Current cash situations is $11.7 billion in cash, while their debt, about 6.5 plus 2.5. So that's how much? $9 billion in debt. So definitely cash rich company. Not bad, right, Wowie? For Costco. Oh, Wowie, I think you're on mute. He asked you on mute.
Sorry.
You're fine.
Congratulations to those that have been buying Costco
Mhm.
before their earnings report.
Right. It's been an outstanding performer, as we can see on this latest report. All right. So we're going to jump on to our weekly roll the clip segment. So we first have here Larry Fink. So he's BlackRock's chairman and CEO. So BlackRock, for those who are unaware, it's the largest, or if not one of the largest asset managers globally. It has over $10 trillion. So people listen to what he says every time he thinks what he thinks about the market. So this is an interview that just happened this morning, June 2nd, garnering 1,600 views in Bloomberg. So let's roll the clip.
Rocky road, can we say, so far this year? As you look forward, is there any real prospect they can recoup in the second half of the year?
Probably not totally. Let's start off. The market has recalibrated itself. We witnessed now a change in policy in the Federal Reserve. We raised short rates. We saw a recalibration of growth stocks. That's principally the majority of the downfall. And yet the index are masking some of the problems because part of the index are energy companies, commodity companies that are up quite a bit. So if you look at the volatility in the market and the spread between winners and losers, it's pretty broad this year. And so we've taken out a lot of those gains that we saw during the COVID years and during the 2 years where we were changing our lives and we were emphasizing different companies. And now we're seeing the reverse impact of that. So that was one of the foundations of it. But now there's greater recognition that inflation is not transitory. It is probably with us for a number of years. And it's the type of inflation that I don't believe the Federal Reserve has the policy or the tools to do much with it right now. And I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated. Demand right now in our economy is about equivalent to the demand that we saw pre-COVID. And so we're witnessing all these supply shocks, and that's creating these attended price increases. And so it's more supply driven. It's been aggravated now, obviously, by COVID and lockdowns in different parts of the world where we are manufacturing goods. It is being further aggravated by the Ukraine Russian war, and where we have supply shocks. But I have this fundamental view that much of the inflation has been generated by some very large policy shifts in the United States.
So it's because of the
The market's
policy.
had sort of a
So it's for him, it's about the policy, supply, demand, and of course, did he mention the Eastern European conflict as well, right, Wawi? Oh. I think you're on mute.
Sorry. Which is a common theme driving sentiments right now. You
Mhm.
know, policy shift, war, inflation. Again, these are all, in my opinion, temporary, because
Right.
the United States economy is very resilient. You know, we still have workers, we still have manufacturing, but we do have a lot of infrastructure needs that that need to be addressed.
Mm-hmm.
But the beauty about the United States is, you know, companies always comes up with solutions, and new jobs are being formed right now, especially in the supply logistics.
Mm-hmm.
So there's an increase in demand in supply logistics personnel to figure out how to, you know, to improve um, company supply chain issues. There are gonna be new jobs forming before you know it.
That's one thing that to keep an eye on, definitely, because so far we have been seeing layoffs, but not in the supplies, but not in logistics side of things, but more on the tech. So hopefully that kind of balances it out come soon. That way we don't see much of people suffering, being laid off, and not being able to find a job. So last part of our roll the clip segment is Oaktree's Howard Marks interview that was yesterday, as you have mentioned to our group, Maui. So this is a quite a long interview. So if we see like any definite things that we can skip, we'll skip. But for now, let's roll the clip.
Psychology, and as a student of history, where are we right now in terms of bullish or bearish?
I think that attitudes were quite bullish prior to a few months ago, with the exception of a brief respite during the pandemic. We've been in a bullish climate since the end of the global financial crisis in 2009. Not wildly bullish, certainly not what I would call euphoria, but optimistic. And that has been crimped now. A lot of the big name stocks are all 50, 70, 80%. The whole market is off, probably 15% from the high. So I would say that attitudes are more balanced today. When there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. So we're happier today than we were 6 months ago. I don't know if we're going to be happier 6 months from now. That is to say that the bargains will be more pronounced, but at least as they say, the bloom is off the rose.
At a time of such incredible uncertainty, how do you position seeing value now, but also preparing for seeing more value in 6 months?
You know, one of the 6 tenets of Oaktree's investment philosophy, which we established when we started in April of '95, and have never changed a word, and I believe in thoroughly, is that we're not market timers. And that means mostly 2 things. We never sell to raise cash to prepare for a decline. And we never say it's cheap today, but it'll be cheaper in 6 months, so we'll wait. If it's cheap today, we buy it. If it's cheaper in 6 months more, we buy more. And I think that that works much better than an assertion that we know where the market will be in 6 months.
This is really important at a time when so many pensions and institutional investors have been shooting for that 7.5% to 8% bogey. We talked about that extensively in the past 5 to 6 years. This idea that seemed completely unachievable in an era of quantitative easing. Suddenly, high yield bonds have an average yield of more than 7%. Is this the best period that you have seen for pensions to actually hit their bogeys for more than a decade?
Well, I think that's right. Well, of course, many have hit their bogeys. It just didn't look in advance like they would, but the stock market and many other things have surprised on the upside for the last 10 years. But now, as you point out, one of our big activities is high yield bonds. And a year ago, they were yielding in the 3%. One deal was even done in the 2s. That's not a very high yield for high yield. Today, as you say, they yield in the 7s. So a pension fund that needs 7 or 7.5 can make use of high yield bonds. And everything, see, when everybody gets concerned when prices decline. But if you flip that over, the flip side of price deterioration is increases in prospective returns. So now the prospective returns are on many asset classes are higher than they were just a little while ago. And again, a much better climate for the bargain hunter.
Some people would counter this by saying inflation takes a lot of the value out of those returns, that basically on a real basis, you're still not getting very much. How do you counter that as a long-term investor by saying, you know what, at this point, it's worth it to get higher returns, even if on a real basis, it's not necessarily that much more?
Well, you're right in that we're not talking about an increase in real returns. We're talking about an increase in nominal returns. Most pension funds and other organizations reckon their need for return in nominal terms. But that is a challenge. And nobody knows what inflation is going to do. I think I heard out of one ear your previous guest say that some of the inflation factors will probably subside in the next few months, which means, all things being equal, an increase in real returns.
How much are you trying?
All right, we're gonna cut it right there, I guess, while we just extending. Oh, I think
it's a long interview. Yes.
For those who are interested, you can look him up in Bloomberg and YouTube. Bloomberg user. They usually upload these interesting interviews. So, according to Howard Marks, the bloom is off the rose, and that it's a better environment for those who are would-be long-term investors. So the price decline kind of shows, like what he said, indicates better returns in total in the coming, not coming days or years. There's no specific time to it. But if you're a long-term investor and if you do not time the market, it's a positive happening, to say the least. What do you think, Bobby?
Well, long-term investors have always been told, just keep it there and just hold it there and, don't even look at it. But really, you should be an active investor, in my opinion. I think it's rather abnormal if you don't look at your holdings.
Right.
But just know things are just going through cycles, and there's scenarios that can affect those cycles to the bear trend or bullish trend. But one thing I know for sure is if you know a value company and its pricing is going down, and you know that that company is going to recover no matter what, and you see it, the price go down, then like he said, that could be a bargain. So it's an exciting time for me. It does not it's not the same as the pandemic, right? We have a lot more complex issues to track right now. But again, the scenario is the same where I'm seeing bargains. So I'm heading forward and I'm buying my value stocks that are on bargain right now, and I'm thinking that things are gonna be you know, in the future. Who knows? 2 or 3 years, who knows? Maybe it will bounce back to normal.
Right.
Uh,
There's no telling, but as long as you have that conviction and belief in the company
mhm,
and for them to grow in a certain manner, Amazon, for example, back in 1998 was trading less than $100, even $10. When the housing, well, when a dot-com crash happened, it was almost down to cents a share.
mhm.
Nobody thought how big it would be at this point in time. But there's certainly one person and one person who have stuck with it through thick and thin, and that's Jeff Bezos. So,
Mhm.
history is a lesson. Hindsight is 2020. But if you stick with them for long enough, there's no telling, and hopefully, it all eventually, recovers or at least produces healthy returns for your portfolio.
Well, what
Oh,
I'm seeing, even
mhm,
international investment companies are investing in the United States.
right.
So they still see the United States as a refuge for their retirement pensions,
Mhm,
their investments. Um, so no matter what's going on in Europe, in China, in the Middle East, they are still investing in the United States companies.
mhm. It's
So that
mhm,
that it's not like they're pulling away from the United States. So if I see that trend, then I would start worrying.
right.
But
And you could
I don't see that.
And you can definitely see that in the week of May when investors globally poured money in US and
Mhm.
Asia, more so than Europe or China. But yeah. Well, Wally, do we have any quote for the week before we end the show?
Just again, be resilient and hold on to your long-term convictions and hang in there.
Yes. Well, Wally, thank you so much for coming on. Listeners, I guess that does it for this episode of Mark You and Wowie Show. If you have any questions, send us an email at markyouandwowieshow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark You, signing out.
And Wabi Santos, thank you everyone.